But what are your expectations from this conference this year?
Thank you, Wally. Thanks for having me. I think Nigeria, without a doubt, still presents a lot of opportunities, despite the challenges of frontier discoveries across the region and outside of Africa. I think we've been stagnated in terms of investment, like you rightly suggested, in the past couple of years, maybe 10 or a little bit more. But I think that's a function of macro factors as well as some of the micro challenges that we have. The macro factors are a function of the market, the demand. There's been a glut in supply, so everyone had to go back and rethink what the norm was. The norm has changed. What you also find happening is this new norm is also accelerating because changes, and by the norm, this new norm, I'm referring to issues around shale production. Cost of production has really reduced, and so competition from that region where shale is produced has become more rife. The second challenge here is a result of the legislative landscape. It's the sense of urgency. It seems like somewhat has been a concern. We've become a bit allergic to that sense of urgency. Oil is a dying resource. Maybe not dying in that sense, but oil is a resource that may become a curse word, just like coal is in the near future. So the sense of urgency needs to be harmonized and concerted across the board. The Oil and Gas Conference, Nigerian Oil and Gas Conference, provides the opportunity for both the legislative arm, the executive arm, and the operators especially to have the opportunity to compare notes, exchange notes, and look at the best way forward given the new terrain that we operate in.
Right. It's an interesting point you make about the opportunity to invest in oil as being financed, but I want to hear your thoughts on that growth of the indigenous oil players. We saw the likes of Seplat being listed on the London Stock Exchange about 4 years ago. One gets the sense that the momentum of investment and growth of the local oil producers appears to have waned over the last few years. Your perspective on that point, and how do you see things changing moving forward?
I think there's a whole sense of buoyancy amongst interested parties within the Nigerian indigenous producing group. The challenge we face in that part of the production chain is partly, again, it goes back to that sense of urgency to maximize existing assets that we know the reserves are there, they're visible. It's taken conversations to conversion. And some of that has hindered growth, it's hindered independent players, it's hindered a lot of the indigenous players. But another concern is financing. The landscape for addressing that has not really been fine-tuned. But those who have done so, like you rightly mentioned, Seplat, by looking at a float in the London stock market, they've been successfully deploying capital. But I think there's also the opportunity for the Nigerian Stock Exchange and other exchanges to also be part of the capital generation piece for the industry, especially for indigenous players.
Right, and I know that many Nigerian banks are exposed to the sector, and while oil prices appear to be moving up again, there's a sense that the opportunity could be there again for them to increase lending to the sector. How do you see things playing out in that respect? Would you say that the higher oil price is really an opportunity for those who are owing the banks to pay, as opposed to them to get fresh financing?
I think there are two things there. The first one is the banks have been heavily exposed because oil prices tanked. At some point in January of 2016, oil prices tanked to as low as $28. So a lot of the financing, which were previously premised on about $70 or a little shy of that, have all been difficult for players to service. With this new trend, it provides the opportunity, provides the opportunity, maybe within even a limited window, for the banks to cooperate and collaborate with some of the existing players who they're already exposed to come together and find ways to service the debt, while as well being, taking some additional risks, but calculated risks to engage new entrants in financing activities. This time, maybe a little less ambitious in terms of the projections of the pricing of crude.